Okay, so investment gathering October. Okay, good. More people are in. So standard disclaimer, make money, be happy, lose money, don't scold me. Okay, so once again, this semester our team is PPIG. We actually had done income portfolio in August. In September, we talk about property. So in October this month, we had some exercises started already. So basically, some of us actually came together on I think 2 Saturdays ago. I think on 19. One Saturday ago or 2 Saturday ago. Okay. We came and played the cash flow game. So I think for those who came, they really enjoyed themselves. The feedback was very good. So of course, today is the continuation of financial planning exercise. So the topic for today is definitely related to protection financial planning, which I will talk about very soon. So next month is growth. So again, same thing. We will have a face-to-face meetup. I will talk about it a little bit later. So do hope that more people can come in. So those who came really enjoyed themselves. More importantly, I got one feedback saying that, hey, I should have uh played this game long ago, or these are knowledge how they wish they know it earlier. So yep, hopefully the November one more people will come in. So same thing, at the end of session, I'll still talk about two income stocks. So for the month. So today also same thing, talk about two income stocks. Okay, so yes, like I mentioned earlier, we actually played the uh, cash flow game as part of this October theme, which is on financial planning and protection. So I think there's a lot of insights that the participants came, and of course, all these meetups, all these games come with a challenge, and a challenge as a winner. So congratulations to okay, so these are some photos. Okay, photos that we have taken on that day. So this is a cash flow game. I think we have about 12 of y'all came down. Okay, so thank you so much. So hopefully more can participate. And like as mentioned just now, okay, so there as every game, there's a winner. And the winner actually win a prize, a dinner for two with myself and Janelle. So Janelle is my financial planning partner, as you can see here. So yes, we are going to have a nice dinner. And the winner goes to Siva. Congratulations, Siva, for winning the game. So by the way, Siva, you have not replied me on your availability. Okay, Siva, I think you're in the house. So please respond to my ability. Let me know whether you can make it on the date that we actually talk about. Okay, Siva is in, right? Siva, you're in, huh? Let me just confirm. Yeah, you're in. Okay. Yeah, thank you so much. Thanks. Okay, great. Okay. So today, on financial planning, okay, I want to talk about risk management. So of course, obviously, risk management is a critical component to financial planning. Okay, and of course, this is also by request. I believe I think Desiree, right? I think also Desiree is in the house. Asked about what are some of how do we actually do a proper risk management structure for our personal finance. So I actually came out something to share. Okay, so feel free. Like I said, this one in Chinese we call it 抛砖引石. So basically, I'm just um coming up with certain ideas, certain concepts. So feel free to come and or jump in and share a view, share opinion. Okay, like I said, I don't have answers to everything, so I try as much as possible. Hopefully, we have like a learning community, not just like, oh, you'll come and uh just learn. Okay, so hopefully everyone can contribute, then make this collaboration more interesting. So I'll talk about how actually I do my financial risk management. So of course, it's just related to finance. So I won't be talking about, what do you call that? When I go travel, I buy travel insurance, things like that. No. So it's purely on my financial risk. I'll share more later on how I manage my overall financial risk, my share investing risk, and property investing risk. So these three parts. So this will probably take about an hour. Then my partner will come in. We will have a bond discussion. So I believe there were some questions on bonds, bond funds, in the chat. So I've invited her to come in to take some of the questions. So hopefully those who have questions, please feel free to ask. And I will review the two income stocks. Okay, so let's get started. So risk management, we talk about the mindset first. So basically in terms of risk management, right? Okay, very simple. We have these three steps. Number one is what are the risks? We identify the risks first. Okay. Then we talk about what are the action we can take to avoid the risk, to reduce the risk, or to mitigate the risk, basically. And then after that, we work backwards. So with all this, all these activities, all these action, can the risk be reduced? Can the risk be avoided? Can the risk be mitigated? So this is basically the risk management mindset that I was talking about. Also, how should I put it? A lot of times there's no right or wrong answer. Okay, or there's no one answer. So it's good to just see what I'm going to share today as a guideline, as a guideline. No hard and fast rule. Okay, and of course, feel free to jump in to share your opinion. Okay, we talk about my overall financial risk management first. In terms of overall financial risk management, what are some of the financial risks that myself or in fact most people will face? So we have like loss of income, basically loss of income. Touch wood, like due to illnesses, due to accident, then the person cannot work anymore, or either that cannot work as well. Then the other one is retrenchment. Okay, so this is happening quite a bit recently. So loss of job. So there's like a temporary loss of income. So this is one financial risk, okay, that many of us face. Number two is a reduction in income. Okay, so like, a pay cut, or either that have to retrench, after retrench, get back to a job that, doesn't pay as well, or same because of illness. Okay, have to take on a job that less stressful and of course lesser income. Lots of savings. So this is also getting quite common nowadays. Basically, that means one lump sum. We have one lump sum in our bank or in our assets, then actually being lost. Okay, so sorry, pardon me. So hope you can differentiate. This one is income reduces. Okay, so this part is whereby, whatever we already have, our savings, is actually lost either through scams. Okay, this one is quite bad recently. For those who are really following how high tech the scam is quite scary. So basically now I think there is one app that if let's say they have your video and your voice, they can totally alter your whatever you say, and match the mouth action, the whoever you say. Just one app only or something. So it's actually quite scary. Yep. Then the other one is indiscriminate expense and lending. Okay, so like for example, because the money is there, suddenly your friends come and borrow money from you, or your relative come and borrow money from you, or like for example, one real case, um I have this relative. Okay, I have this relative. Then the son is not doing very well in school, probably cannot get into a local university. Okay, and because they can afford to send overseas, so that's why it's like, hey, why don't I just send overseas, things like that. So because of that, then one huge sum money gone. The other one is, I know this person, the daughter wanted to be a doctor. Okay, then somehow cannot get into the local medical school. Yeah, then it's like the daughter want it so much. So she's like, okay lah, really squeeze every single cent to actually go and send a doctor, a daughter to go and to be a doctor, a daughter to be a doctor. Okay, so things like this, loss of savings, is something that we also must, is actually quite a huge risk now lah. So of course our own kids, nothing to say lah. But what about, let's say, nieces and nephew? You know, if let's say your niece, your nephew, really got doctor potential, but because uh either cannot afford or just meet certain points to study local U, so would you actually want to sponsor? And sometimes you do have the money, then you end up, okay lah, just take it, something like this. So yeah, this is I would say is one risk that we have to look after. And things like unplanned large expenses, illness and accident, any person in the family, or increase in education expense, so very similar to the loss of saving parts, whereby yep, actually was planned for local university, then in the end to go for overseas university. Okay, so these are some of the financial risks I have identified. Yeah, so maybe I just take a pause here. Did I miss out any risk? Anybody want to share or just jump in here? What are the other, we talk about overall first, so later I will dive in more in detail about shares, risk related to share investing, risk related to property investing. Any other risk that do you think I've overlooked? Anybody want to share? Okay, maybe I just pause here for a while. So all the risks are here. Okay, leverage risk, I'll talk about that a bit later. Yes. IPO risk, IPO risk is a share investing. Okay. Okay, but we talk in terms of overall, overall risk first. Okay, Ken, thank you so much. Okay, so let's go into mitigating action. Yeah, Desiree. Yeah, I have actually had one part to answer your concern. Okay, so yeah, let's go to some of the mitigating actions. So of course, number one way to mitigate is to build reserve lah. Okay, build reserve. What I found useful is actually doing a system. So I know some people do budgeting, but I do find this part, the pay yourself first, is actually very powerful lah. So as long as your money come in, okay, you immediately take 20% of the money, okay, go into your investment account, or I call it the restricted saving account. Okay, so whatever 80% down there you spend, never mind lah, but the other 20% come in. Okay, so I realized, okay, just using this method is actually more useful in trying to build reserve. Okay, I know what some people does is they try to keep track of all their expenses. So far, I haven't heard of a very successful stories. Okay, yeah, so if you keep expenses, but in the end, still spend away. So I thought this one is quite powerful. So it actually works for me like during my younger days. So whereby I start opening up another account. Then when the salary comes in, I immediately put 20% here first. So of course that is for investment. So that is something to build reserve. Obviously, reserve is very important. For like temporary loss of income, so and so forth. At least the reserve is actually there to sort of buffer it. Okay, now, okay. So this is the part that get a bit tricky. So of course, this 20% is for investment purposes. Investment purpose. So the question here is this. So if let's say, for example, you actually pay insurance, should the insurance pay out of your this saving account, or insurance pay out your investment account? That means you actually allow yourself to use this 20% to pay insurance. Okay, so if let's say you think that it's okay to use this 20% to pay insurance, don't mind, just tell me type of one. If you think that no, insurance be paid out of the the rest of the 80%, please tell me type of two. Okay, thank you so much. Thank you so much. I think you all got the answer I'm looking for. Yes, so of course we must differentiate. So unless like what Kiet Huynh is saying, unless you actually mix insurance with you mix insurance with investment, then maybe you can actually pay out this 20%. If not, insurance also, if let's say it's just pure insurance, if pure insurance is just an expense, okay, what are pure insurance are basically like your term insurance, okay, like your term insurance, that one is a pure expense. You pay already, you don't get anything back. Also, that should be part of your the rest of the 80%. So unless it's like life policy, okay, unless it's like life policy, then you can use this 20% to pay. What about property mortgages? Okay, if you think that the property mortgage is okay to use this 20% to pay the money just at time you want. If you think that property mortgage is an expense, okay, you should be paid out of that 80%. Please help me type a 2. Okay. Okay, thank you so much. So again, this one is a little bit trickier. Okay, so my point here is this, like I said, this one just serves as a guide. Okay, like in my case, okay, I think 2 is correct. Yeah, 2 is correct. Is expense per se. Yeah. Okay, no. Okay. So basically it's like, for example, okay, is it self-stay or investment? So if let's say it's an investment property, so in fact, if let's say it's an investment property that actually generate rental, then of course it's quite clear cut. Then I think we can use this 20% to sort of like pay for the mortgage. Then it's an investment. Okay, that's an investment. Okay. But if let's say if the property is a pure own stay type, then correct. Then maybe we should treat it as expense. But let's say, for example, you have upgraded to from a smaller apartment to a larger apartment, and eventually you don't mind to downsize one. Okay, I think it's actually can be considered as an investment as well. Okay, end of the day, you have to be realistic okay, because it's not like, you make your life so miserable, everything pay from the 80%, the other 20% just full. Then in the end, you don't enjoy your life today, also not good. So personally, I would actually say that if let's say property, there is an investment angle to it, be it a second property is very clear. Okay. But if let's say, for example, is you have upgraded, okay, from a small to bigger one, I think it also may make sense to pay off this 20% because you're also accumulating funds. Cost and all still need to pay and still expense cannot stop. Okay, I think this that is another point. There's also I think it's a little bit different from discussing. I think still one cost property as yes, Indra, that is what I'm talking about. That's what I'm talking about. Okay. So yep. So I hope this give you a guide. To give you a guide, there's no hard and fast rule. Like I said, I personally see this as one. Property, I see this as one. Okay, even though I only have one property, but I have actually sort of upgraded to a larger one. So I see this 20%, I'm actually investing in that property. Okay. So hope this will give you some guideline. Now, okay, one part. Sure. Arvin, don't have to agree with me. You want to say something, Ravin? Yeah.
Yeah,
Feel free.
if
Yeah.
yeah. It's like you pay, you have to stay somewhere, right? So
correct. Yes.
Housing is a cost.
Yes.
Right. So you should treat it as a cost. If you whether you are if you upgrade, you're paying more rental basically. You're paying for when you move from say Ang Mo Kio to I don't know, to Orchard Road. yeah, you if you were renting, you would pay more now.
Okay, okay.
Right. So it's a cost. I mean, so I would your property or primary residence, yeah, I think should be treated as a cost and come out of your 80%, not from your 20%.
Okay, okay. Yeah. I mean, that's one angle to look at it. The way I want to argue against is yeah, rental is quite straightforward as expense, but if mortgage, right? So mortgage is actually there's two parts to it. One is interest payment. Okay, that one paid to the bank one. Okay, so no need to argue that one confirm is a cost. But there's actually one portion is actually to pay down the loan. So if you think about it, if you actually paying down the loan, right, you're actually saving money lah, in that sense. You are saving money, you are saving money inside a property. Okay, because you are paying down the loan. Okay, as you keep paying, then after that your loan gets smaller and smaller, then eventually the property is yours. Then you could actually liquidate it. Eventually lah, after you save. Okay. Yeah, so anyway, I think there's no right or wrong here. The point here is this it's a fine balance. So of course, if you can come up on this 80%, that's great lah. That's great. That means 20% pure. But if you can't, like for example, if you say that, because of that, you have no money, because you only want to stick to 80%, and because of that, you have no money to upgrade or no money to buy a second property, that may not be a good idea lah. I think that's my point here. Okay, but I think Arvin has a point also. So end of the day is a balance. Okay, so in this building reserve, so now why investment? I realize there's actually another very good purpose is you don't keep cash. You don't keep cash. So I realized that, at least I've been reading articles about scammer and those people who actually scam. It's like they put like $1 million in a bank account. Not even in FD. So it's like, for example, $1 million in saving account or 200,000 in saving account. Like for example, now my saving account, I think only got $3,000. So which touch wood, which means to say, if let's say, it's the saving account that gets scammed, my max is 3,000. Okay, so the rest of my money is either what do you call that? Put in different places or either lock into investment. So for me to remove the money, I have to sell something. So it's also a very good process in the sense that because usually touch wood got scammed, right? Well, the first is the anxiousness. Then immediately go and take it. Like in my case, I no matter how immediate, I have to go and sell something, then go and take. Then I think further. Also, so that is also something for you all to consider. That's why it's actually good to don't keep cash now. Especially the scammer is it's not about how smart you are, if they are really very good now. So it's actually good to build all these defenses, okay, in your money. Okay. Then of course need to diversify. We need to diversify. Okay, yeah. Then of course you spread out the risk. I'll talk about diversification a bit later. Okay, so shouldn't we keep at least 3 to 6 months of expense okay. So like for example, like stocks are actually quite liquid. Or either that, you can put it in FD or in funds. Okay, the worst to worst you lose is the interest. Okay. So it depends on I mean, to each his own. So to me, it's like even I keep money in the stock market, I would still say that it's liquid enough for me. Okay, so it's like when I really need the money, I go and sell it for 5 days. So okay, it's not like I have to wait for like 1 month, 2 months and things like that. Also, of course, everything through in the property cannot. But you're right in saying that 3 to 6 months in cash. Or the other way you can think of it is you actually split it across different bank accounts. So don't really have like one huge in one. Okay. Yeah. Okay, another exercise that I just want to share, which I thought is a very useful, is actually this thing called just track your money. Anybody does that now? I know I've been sharing this quite often. Can I just check anybody start tracking their money at least on a quarterly basis? If yes, don't mind just saying type of one. If you have not done so, please tell me type of two. Oh, great, 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 great. Nice, 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 nice. Okay, okay. Okay, good, good, good. Well done, well done. Okay. So again, I think this is a very important exercise to let your money grow. Okay. So for those who have not done so, seriously consider I do it on a monthly basis. I actually don't really have to do a monthly basis. What I do is I just okay, of course, all these numbers are doctored already. These are not my real numbers. So I just keep like how much cash I have in the bank account. Okay, what is the market value of my shares? What is the market value of my unit trust? Okay, what's the market value of my CPF account? I actually track my insurance, the cash value. So insurance, they actually give the cash value. Okay. I even put the market value of my car, apartment. Okay. Then I calculate this thing called the total equity. Okay, which basically add everything together. Okay, add everything together minus off the loan. So assuming I have the housing loan. Okay. Then after that, I keep track of this thing called the disposable asset. Disposable asset is basically things like, for example, cash in bank, shares, unit trust, things like that. That means it can be liquidated quite easily. Okay. So down here I also look at my insurance coverage, life and term and things like that, so on and so forth. So I think it's good to keep track. I realize, at least for me, this is a very good exercise for me to build reserve. Okay, so I think one of the learning points we learn from the cash flow is sometimes money don't grow is because we just leave our money everywhere, and we don't know where are they lah. We don't really keep track of money. Okay, got a bit of money here, a bit of money there, a bit of money here, a bit of money there. Don't keep track. So really, if let's say you start keep tracking, that's like, okay, you actually watch it grow. It's actually a very good way to actually build reserve. Okay, yeah. Yeah. I think I will just share this here. Anyway, all the numbers are doctored. So these are all not real numbers I can share. So basically what I do I call this the personal balance sheet. So from here is all the assets, all the assets. Okay, equity is just the asset minus the liability. Okay, asset minus the liability. So my housing loan is by liability. Okay. So I think this is a better way to track rather than just trying to track. They call it the income statement. My what is my expenses. So down here you can really track your reserve. Okay, Prem, what do you mean the shares market value? If you go to your CDP account, the market value is there. Are you talking about that? So if I log into CDP, if let's say my stocks in CDP, then it's there, isn't it? Then or either that, if let's say I track my stocks in a particular broker portfolio platform, then they also give me the market value. But personally, I track CDP. Big bank, digital bank. Okay. Will you take a home equity loan to generate more cash to put into investment? Okay. We talk about loan later, Rickson. Maybe that will answer your question later. Yeah. Oh, okay. So Arvin actually uses Yahoo Finance to track. Okay, so maybe can learn from Arvin. Okay, there are certain platforms. I still like to use Excel. And this is my monthly exercise. Monthly exercise. It's actually I thought it's quite good if you talk about building reserve. Then if let's say, so like I said, this platform is doctored lah, you know, I'm definitely not going to show you everything I have lah. Okay, then my US, there's certain platform that can actually track the US stock value. Yeah. Okay. Good. So start doing it. For those who have not done, start doing it. Like I said, it's very good to build a reserve. And also sometimes a lot of people, okay, a lot of people actually, we're actually quite lucky. Our generation is actually quite lucky in a sense that most of us have, if let's say you have been working, most of us has some reserves. Okay. And seriously, then of course, with that, it can help you make decision better. You know, let's say, for example, like in my case now, I'm 50. I don't know how long more can I stay healthy, or either that, how long more can I stay energetic. Okay, so actually this one also helped me to decide, maybe it's time for me to step down a little, go and do something different. If not, before I cannot afford to do it lah. You know, I cannot be like, you know, after 65, then go and jump off the plane, go and do skydiving and things like that, you know. So I do know of a group of Singaporeans who would already very rich, but somehow they don't feel rich. They feel that I better work until like 60, 70 years old. If not, I don't have enough money. I see this group of people, and it's quite sad lah. Then after that, they realize that on the day they die, they got so much money left. So sometimes this exercise actually can be helpful. Okay, can I will send this spreadsheet across. I think should be quite safe lah. Okay, A to column ZZ. Waiting to jump off the plane. Okay, good for you, Arvin. Please go and do your heart check first. I think my heart check failed already. Uh, okay, so that's one, building reserve. So that is one of the main mitigating factor against, you know, loss of income, blah, 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 so on and so forth. The other one is, of course, insurance. I think there were some questions on insurance. I know I've been talking about this quite a bit already. So I'll just go and run through very quickly and see whether if there's any questions. So basically, insurance, there's three main parts: hospitalization, dependent, and income replacement. Then, if you ask me, the most important is hospitalization. Okay. Dependent is only important if there's a dependent. Okay, so there are a lot of people who makes up dependent and income replacement. So especially I met people before, no dependent, go and buy insurance that's for dependent. So that's waste of money. Waste of money. And of course, income replacement. So one thing is that the thing is this income replacement is something like, for example, early stages cancer. So the question is here is this: if let's say you're retired already, do you actually still need this? Okay, so that's why from this insurance, okay, we may be able to save some money when we retire. So something to take note. So ideal scenario here is this: hospitalization. I think we should protect maximum protection if can afford. That is my personal opinion. Okay, so that's my personal opinion. I think that's the most important. This is the only insurance which I probably going to hold to end. So of course, why go for maximum protection, which is basically your for cover up to private, get all the riders. Because as we age, our population is aging. So I'm not too sure how good the public healthcare can catch up. I know they are doing a lot of things. I don't know how good the public healthcare can catch up. So if you're under private, then of course you have some choice. Because if you're on private, you want to go to public, you still can. But you're on public and go to private, then you have to pay a lot more. So this is the one that I will spend the most money on. Okay. Okay, I also realized that some of us actually forgot to cover for our parents. Okay, this one, please remember. Okay. There are people who I just met who say that, hey, my father was like self-employed, don't have insurance. Actually quite scary. So this one potentially could be like one huge expenses going down the road. So I think can even cover up to 70, 75 if they're Singaporeans and things like that. So this is something for those who have not started looking, please do so. So to prevent the risk of, one huge financial expense coming up. Okay. Dependent, usually it's the payout upon like terminal illness or 1 year lifespan. Okay. I would suggest that use term policy to cover. Okay. Use term policy to cover. That means don't tie with what they call that investment type. Or don't mix it up, don't tie investment, just use term policy. Then it's actually a lot cheaper. Okay, it can be a lot cheaper. I would actually cover the property loan portion as well, so that touch wood anything happen to me or happen to that person, at least whoever that is still around have a place to stay lah. Okay, like for example, now once you go into private properties, right, it's not a must to buy the loan insurance. It's not actually a must. Okay, it's not a must. So what is recommended is you just use a term policy, okay, to cover for the loan portion, just in case the main person paying the loan, okay, it's not around anymore. At least the dependent, they still have a place to stay. Okay. I would also just cover probably like I mean ideally speaking, we could actually just cover the living expenses, the dependent up to 18 years old, and if the spouse is working, actually don't have to cover. Okay, so and eventually, right, when the dependent can take care of themselves, we may actually want to stop the coverage. So I think this is the part whereby I think a lot of people may be overinsured. Okay, if let's say, for example, after we retire, our income reduces, right? Okay, this is one area we may be able to save costs on. Okay, this is one area we may be able to save costs on. Okay, I think there was this discussion is like, after you retire, then how come my interest expense can actually reduce quite a bit? Okay, because this is one area I probably going to cut. Also, basically, now I'm covering for my daughter expense. Anything happen to me, at least my daughter have one sum of money. Okay, but when my daughter start working, maybe I will stop the insurance already. Okay, property loan also. So eventually, when I fully paid, I may not cover that property loan, and my spouse is working, so I may not cover. So this is one part that can actually save some money when we retire. Okay, income replacement is usually things like early stage cancer. Same thing, you can also use term policy. It's a lot cheaper. If you actually use things like with life policy, it's actually more expensive. And if you want, it's like cover for 5 years of expenses. 5 years expenses. Because the idea is this, why 5 years? Basically, touch with that person who got cancer. Okay, 5 years later, okay, by right, he or she can go back to work already. Okay, because the premium for this policy is actually quite high. Okay, so again, same thing, may consider stop coverage upon retirement, because once we retire, okay, we don't have income already, so why do we need an income replacement policy? So again, this is one area that can save costs. Okay, I think there's some questions. Your dependent insurance is referring to critical illness insurance. Yes. Okay, most of the time, yes. So basically, if I know now it's worded, it's not so straightforward. I actually talked to the insurance company, they also cannot give me a clear answer. But what I understand here is this critical illness. So in terms of cancer, it's only stage 4 cancer. That means they won't pay out for early stage cancer. But some say maybe you can appeal, then maybe cancer. I don't know. But generally is the critical illness. You're right. Okay, or either that is the accident whereby the person meet the accident and go. Okay, so Kevin, how old would you use critical illness coverage up to what age? The higher, huh? Okay, so Desiree, yeah, okay, I think this is where you're a bit confused. Okay, so basically, if let's say you have the hospitalization, it will cover for your illnesses already. If you in terms of the medical expenses, so that's why I say this hospitalization is the most important. It cover for the medical expenses. Okay, so this one is one lump sum one, give you one lump sum. So you have to understand the lump sum is actually for what lah. So generally speaking, the lump sum is actually, if let's say it's for terminal illness or critical illness, the lump sum is actually for the dependent. Okay, so touch wood, anything happened to that person, then 1 year later he's gone, his dependent got money to survive, to pay the property loan, blah, 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 so on and so forth. Okay, but my point here is this: if let's say the dependent grew up already, maybe you can save a bit of money there. So okay, but having said that, I would also not cancel totally lah. Okay, so assuming that my my dependent has can take care of herself, my spouse can take care of herself, I will not stop totally lah. Okay, reason being that, like for example, now cancer, there's this cancer drug list, or whichever that is actually not in the list, right? Okay, you have to fork out money. You have to fork out money on your own to actually pay for it. Okay. So that one, the hospitalization don't cover. So it's still good to cover a little, but probably a lot lesser lah. A lot lesser. You don't need like millions of dollars here. Okay, I know of people like dependent and income placement cover up to like 3 or 4 million. Then I think that is overkill lah. That's overkill. So unless you are super rich, you don't mind even when you retire, keep paying the premium, then that's fine lah. Okay. If not, it can be quite hefty lah, especially when retire. Dependent, yes, usually it's the term plan up to 70 years, so you are correct, yes. Okay. Yeah, so I think the main point I want to put across at this part here is this. For insurance, so number one, differentiate what is it for? And number two, when we retire, actually certain insurance we may be able to stop. Okay. But of course, if let's say we can afford to keep paying, go ahead lah. You know, if let's say money is not a concern, we have spare cash, I don't mind keep paying lah. Even though I do have dependent already. It's so still good that even my daughter is 50 years old, it's still good that when I die, I can pass her some good money. I don't mind doing that lah. Okay. But if let's say, I'm working with limited resources, these are the things that we actually can afford to cancel out. Okay, then of course, the third part is to build alternative income. Both spouse working, can have 2 properties, build a dividend portfolio, active trading, and things like that. Use SkillsFuture credit. Okay, so this is how at least I've been thinking of to ring fence my finances. Okay, so me and my wife working. There's one point in time we almost have 2 property, but in the end we chose not to. But that's why I actually keep building the dividend portfolio, and I do a little bit of options trading. So something to build alternative income. Yeah, SkillsFuture lah. Go and learn a new skill. Okay, investment wise, it's good to diversify for risk management purposes. Okay, so what we are talking about, all this is for risk management. So it's good to diversify for risk management. And I actually split it into 6 parts for me. So again, as a guidance, okay, maybe give you some guidance. So I have money in CPF, obviously. So I buy annuities. Then dividend portfolio, which is basically REITs and blue chips. I do growth investing, okay, in terms of buying thematic ETFs, like for example, what do you call that, US ETF or tech ETF or crypto ETF or some China funds. I'm to China funds. Okay, options investing and property. So like I said, property could be the property you own, you just buy a bigger property. So again, it's good to understand what do they cover. Like for example, my CPF annuities, I intend to target to generate enough passive income to cover my basic expense, which is about 4,500 per month for 2 packs. So this was I shared during my preview. I hope you all can remember. So basically, for me to retire, I need about 4,500 per month to cover me and my wife basic expense. Okay, basic expense. So that's what I target the CPF and annuities to do that for me. Okay. So I think there's a question of how do you actually allocate money among all these different portfolios. So eventually see what you want them to do for you. So obviously why I want CPF annuities. So this one, the returns are quite low. You're talking about 4% even for CPF. Okay, but it's more or less more guaranteed. I cannot say guaranteed, but it's more guaranteed compared to the rest. So if let's say I lose other investments, okay, I know that I still have about 4,500 per month coming in. Okay, so this is this is how I decide how much CPF. Yeah, I think there was this discussion of should you actually put FRS, should you actually put ERS? Okay, so really is the amount you want to set. Okay, my dividend portfolio, I am targeting to generate passive income to cover my luxury expense, which work out about 2,500 per month. So I am trying to build like a 500,000 portfolio. Okay, 500,000 portfolio. Okay, so that if you go and do the maths, about 6% return, I should be getting 2,500 per month. Okay, around that range. So this one is to cover my luxury expenses. Okay. Then I always like to jokingly say, if let's say that year my dividend portfolio performance good, I go to Europe for holidays. If the performance bad, actually JB quite fun. Go JB for my holidays. Does your 4,500 include insurance, premium, housing? Okay, so this one is when I retire already. Okay, when I retire, I shouldn't have any housing loan. Okay, you'd be quite miserable. I retire, still got housing loan to pay. No, I'm not, unless it's for investment purpose, which I don't think I want to do that. Okay. Car loan, same thing. When I retire, I don't think I will be driving or either that I make sure I don't have a loan for that. Okay. Insurance premium, yes. So that's why I said, that's why if let's say I money is an issue, I will just cut off the rest. I just keep my hospitalization one. Okay, I just keep my hospitalization. And the hospitalization, I think we discussed in the chat also. Your MediSave, actually the bulk of it can be covered by your MediSave account. Okay. I don't think the MediSave account can cover fully for the hospitalization premium. Either is it MediShield or Income Shield. Medicine cannot, but that one can cover bulk of it. Okay. Yeah, so this one is to cover. So let's say you want to allocate between dividend stocks or CPF. Hopefully this is how we differentiate. Hospital insurance increase as we age. That is correct. Yes. Definitely. Okay, definitely. So like I said, that's why, in the event that's what, if I really cannot afford, then I will just stop my dependent insurance, my early stage cancer insurance. Hospital is the one that I'll keep. Then MediSave, hopefully MediSave can cover, and the rest will come out from here. If really, really cannot, then no choice, I'll have to downgrade to the public one. But you're right. Hospital confirm will go up one. Confirm will go up. Okay. Okay. So for this part, I would say that do it only if you know what you are doing and there is a need to lah. For growth investing or option investing, um, many a times you may end up losing more money okay, than making money down here. If let's say you're only half-hearted okay, I've seen people say want to be growth investing, but don't want to read about companies, don't want to learn, they just want to throw money there. Okay, very likely they lose more. So do it only if you know what you're doing. Okay, I would say this one is definitely not passive income, very active income. Have to spend time, and there's a need to like personally, I am motivated to do it here is because I want to achieve my financial freedom earlier lah. I don't want to wait until 65 lah. So basically down here is, if you have to depend on CPF, right, do wait until 65 lah. So if I can generate some results from here, then maybe I can achieve financial freedom earlier. Also, this is for growth investing and option investing. And property is used as my reserve. Okay. If basically for whatever reasons I cannot generate $77,000, I can do what I call the rental spread. That means I rent out my current property, I go and stay in somewhere smaller. Or of course, I can right size the property lah. Okay, to generate some cash. So generally speaking, use as a reserve. Ideally, I want to keep it till the day I die. Then after that, I'll just pass on for legacy purpose. So this is probably the only thing. Okay lah. Won't be the only thing lah. One of the assets that probably can pass on to my next generation. Okay, so my point is this. I think there was a question of how do you allocate funds across this different instrument. Hopefully this one give you a guide. Okay. Okay, so number one, in terms of risk, we must diversify. Don't put all money in CPF, don't put all money in annuities, don't put money in dividend. Okay, it's good to diversify. Okay, because we don't know. Okay, there are a lot of variables. Okay. Like for example, CPF, there's one point that says there's a rumor that says that maybe 70 years old, then you release the fund. That was a rumor. I think our PM at that point in time came out to clarify, no, that's going to happen. Then yeah lah, dividend portfolio, you never know. Okay. Companies whether will be there for the longest time, we don't know. Okay, so basically it's good diversify. That's one. Number two, how much for each segment? Hopefully this one give you like what they call that, give you like a guide lah. Okay, Desiree, answer your question. Talk about loan. I think there's someone on loan. Okay, so in terms of loan, we talk about loan first. Good debt versus bad debt. So good debt is the one that can help to make more money, obviously. So bad debt for expense. So my personal rule is bad debt, avoid lah. I don't borrow money for expense. Okay, don't borrow money for expense. Okay, like for example, like your credit card, it's quite crazy. If you actually see the credit card interest is 27%. So hopefully now view on credit card debt, 27% per annum. That's crazy. Okay, it's not that 2% it says per month, 27 per annum. Okay, so if you want borrow money, borrow from me, I charge you half of it, 13%. Okay, so borrow money for expense, definitely bad debt. But borrow money to make money, I think that's okay. But of course, we have to sort of have a sense. So I think Desiree has a question just now. How much? We see whether whatever I go through, does it give you a guide? Okay. There are some other expense loan, car renovation, student loan. Okay, so something to take note. There's actually this thing between flat rate and effective rate. If you know the difference, don't mind just tell me type of 1. If this is the first time you hear this word flat rate, please tell me type of 2. Okay. So please take note. So like sometimes a lot of people for expense, they mix up. So what? Okay. So like for example, car loan. So basically all these loan, they actually use this thing called the flat rate. flat rate. Okay, like for example, this article here, this is from OCBC. Interest rate of 2.48, effective rate of 4.65. Okay, so basically the one that is comparable to your bank interest rate, the one that is comparable to a property interest rate is actually this 4.65. Okay, so the point here is this, it says here 2.48. In actual fact, the interest rate is 4.65, or to be very precise, this is called a flat rate, this is called the effective rate. Okay, and for us to measure, we use effective rate. So basically, my point here is this, all this car renovation student loan is actually not cheap. You're talking about 4-5%. Okay. Now, what is effective rate? You borrow 1,000, effective rate of 2% means $20. Effective interest rate of 2% means $20. 2% of 1,000, $20. What is flat rate? It's just a very easy way of calculating money payment accepted by the market. So somehow market got a lot of lazy people. Then they want to calculate what is the mortgage payment. They want a quick and dirty method. That's why the flat rate actually came out. Like for example, you borrow 1,000, flat rate of 2.48% for 7 years, right? So how you calculate? Very simple. Total money payment is 2.48 multiply by 1,000 multiply by number of years plus the amount borrowed. Divide by 84 Divide by 84, which is the money. So it's 13.97. So this is the total monthly payment. That's why flat rate exists. Okay, it's just to help people to calculate the monthly payment without using a financial calculator. But if you want to convert to effective rate, see 2.48. Okay, so basically this 2.48, how do you get 4.65? I have the Excel to also show you. Okay, you have to go and put through an Excel formula. Can you say like every month I pay 13.97, I pay for 84 months to borrow $1,000, the actual interest rate is 4.65. Okay, I'll send you this spreadsheet. So it's the same spreadsheet, but just have to play around with the tabs. Okay. So long story short, when you actually just see things like sorry, where is it? Hey, wrong. Okay, long story short, if you actually just see things like 2% is actually not 2%, it's actually 4.65%. Okay, so take note of that, think of that. Okay, so a good debt is, of course, you can borrow money to make more money. So like for example, property loan. Okay, a property loan is a good debt when the renter can cover the interest. So let's say you buy for rental can cover interest, or the capital gain is likely to cover the interest cost. Then it's a good debt. Margin on REITs, the dividend can cover the interest expense. So I basically borrow money to buy REITs. The yield can actually cover. And structured product. Okay. So there are quite a bit of structured products. Okay, it's generally not advisable for retail investor unless you're very familiar. Okay, so of course, this one we are making assumption that the investment is likely to be stable. Okay. Mortgage is not flat rate. Mortgage is effective interest rate. Okay. So flat rate is only for like car loan, renovation loan, student loan. If you talk about mortgage, it's actually not flat rate. Mortgage is effective interest rate. Okay. Now, let's again, like I said, there's no right or wrong. I just want to go through different scenario. Then hopefully this one just serve as a guide. So let's say, for example, you buy $1 million property, you have 500K. Okay. So what will you do? Will you A, just borrow 500K, or will you B, borrow maximum of 750K at 2%? A or B? What will you do? Okay, A is you got 1 million, right? Okay, you will just have 500, you borrow 500K, then that's it. B is you borrow 750 at 2%. A or B? A or B? Any more answer? B, okay. Okay, B, right, then the remaining funds, where will you put? If B, then you have 250,000 extra, then where will you put? Where will you put the money? Okay, so what investment that give you more than 2% dividend? REITs, okay, you put REITs, okay. Okay, so no right or wrong lah, but I personally, from the risk perspective, I want something more stable. Okay, I would want something more stable. So what is actually more stable and give more than 2% interest? Okay, FD, okay, at this period FD, yes. What else? T-bills, thank you so much. What else? What else? SSB, yes. For this period, yes. Corporate bond, maybe, okay. Why not CPF? Thank you so much. Yeah, that's the answer I'm looking for. Yeah. So yeah, I think it makes sense. If I can find something more stable. Okay, like by for example, if let's say it's 3%, 3% basically 3% basically is what do you call that? You know, is higher than the SSB, the CPF, and so on and so forth. So if let's say you want a 250, then you have to go and invest at 250 into a higher risk instrument to give you more than 3%. Then that one is to which is own. So personally, I wouldn't do it. Okay, personally, I do it. So let's say, for example, I need to borrow at 3%. If I can borrow 250,000 at 3% extra, then at this 250, I need to generate more than 3%. And I can only use more risky instrument I read. Okay, I probably would not do it. Okay, I probably would not do it. Okay, so there's really hope there is no hard and fast rule to answer your question how much. But in terms of risk wise, like you said, okay, you actually borrow extra 3%. I would want something more stable, like CPF. If it's CPF, FD, okay, CPF, FD, SSB, T-bills, okay. If let's say they can give me more than 3%, okay, I'll put. If not, I will not take the loan. Just take, have additional stress. I go and buy REITs. I think that can be quite stressful. Okay. Okay, CPF is liquid. Indra, to pay the property, you can use the CPF to pay down the property anytime. So that one is quite okay.
I mean, for this one, I have a question.
So
you borrow from bank, right? You put to CPF.
Yeah.
Then you need to pay interest using cash. How to pay the interest to the bank?
What pay what interest? The 750 interest?
The 2% interest.
Yeah. Then
You have to pay in
you
cash,
can use your CPF to pay also.
pay
You can
the
use
bank.
you can use CPF for property loan. You can use CPF to pay. This one is property loan specific.
Oh yeah.
You can use CPF to pay.
Okay.
Okay.
Thank you.
Yeah. So there's this question by Rickson. Would you cash out profit via home equity loan when your property value increase so as to generate more cash for your other investment? Okay. So the question is, do you have additional need for that kind of money? I think Rickson That's my question to you. So of course, if let's say, it's a function of motivation, you know, if let's say, you know, you take the money out, okay, assuming now it's about 2.6%, you go and take some cash out. That means you borrow more, you got 2.6%, then you have this stress to keep performing at 2.6% more lah. Like I said, I don't have a very clear answer. But my point is, if let's say I were to do this, I have to make sure that particular instrument is very stable lah. So in fact, I wouldn't even want to like take the money out and put on REITs. I think the risk is too high for me. If let's say, for example, in my case here, I have 250,000 extra, I go and buy REITs that give me 6%. I think the risk is too high for me. Okay, so to each his own. The key here is for that potential additional money I generate, what is it going to be used for? If I have no clear use, then why want to lose sleep over it? Okay. Okay, so Arvin, I think share my view. Okay, Julie, you're right. So you cannot just top up you cannot top up one shot lah. You cannot top up one shot. Take out all our OA money to invest into something stable. Yeah, Kevin, I don't understand you. Are you able to take out OA money to invest in REITs or dividend stocks? I think that is whatever you earn. Okay, so the CPFIS I don't think is for OA. Okay, I don't think it's for OA, it's for SA if I'm not wrong. Okay, in any case, again, you go back to this page lah. Okay. Go back to the one whereby how you differentiate lah. Where is it? Okay, go back to this page whereby where you want what you want your coverage. Like for example, in my case, I want something more guaranteed and I need it to be like 4,500. So I think CPF and NT is actually giving me more. Okay, thank you so much. Okay, can use OA. So to answer Kate Huen's question, you know, so what you're saying here is this: even my 4,500, I come from dividend portfolio. Then you lose that guaranteed element. Yeah, I'm glad you actually attended this. So basically, you're not concerned about risk already. You always think that dividend can do better than CPF. So which is a wrong assumption. Okay. So in fact, my this 4,500, I want something very steady, very stable. CPF, OA, SA just do the job good enough for me. Unless you are saying that, okay, my SA already got so much money inside. Okay, can 4,500 not a problem? Then okay, it makes sense. But this amount have to come from something more guaranteed. And dividend is not guaranteed, relatively speaking. Okay. Thank you so much, Desiree. I think that's the point I'm talking about. So there are people who actually use CPF to say that, oh, go and buy into some trusted unit trust and things like that. In the end, they actually lose everything. So to me, that 4,500 have to come from something very stable. So to me, just CPF OA 2.5%, SA 4% is actually very good. Okay, I'm running short of time. Maybe I just do one more of this scenario. So let's say you have a FD of 200K at 3%, a car loan flat rate of 50K, 2.5% flat rate, property loan of 500,000, 2.6 effective rate. You have no other spare cash. Will you make any changes? If so, what are they? Sell the car. Okay. Do you mean that you'll pay off the car loan? Yes, I think, yeah, I will actually take some money to actually pay off the car loan. Don't forget, 2.5% flat rate. Now, based on my example just now, it's actually quite close to 4.6% effective rate. Okay, 4.6% effective rate. So that is something you have to consider. If let's say your FD is only 300, it's only 200K at 3%, you may actually want to pay off this car loan if it's actually 4.6%. Okay, now, will you actually take the FD to pay off the property loan? Yes or no? Okay, you do not, since this one is actually more than 3%. Okay. So since your FD is actually getting better, okay, so it's also good to actually keep some spare cash. Keep some spare cash. Okay, thank you so much. So that you actually have some spare cash. Can. So again, like I said, there's no hard and fast rule, no right or wrong. We have to see it case by case. Of course, the general principle is we do an interest rate comparison. Then of course, if you actually want to borrow more to make more money, so number one, do you need the additional money? Number two, that kind of additional risk, is it worthwhile for you to take or not? Okay, so I think just now we had quite a good discussion. Like for example, this one, I borrow extra, I put into REITs. I also don't think it's safe enough. Okay, why I actually want to stress myself? Okay, what if the REITs collapse? And I think Desiree just now actually gave a very good example. That there are people who actually use CPF to go and buy unit trust, then end up losing quite a bit of money there. Okay, I just want to have a quick summary of what I've been talking about just now. So basically, in terms of risk management, right? So this is what we do. We actually list down the risks, like what I've done just now. Then we have implement all the risk the risk measures, implement the risk mitigating measures. Then of course we have to one last step to make sure that all our risks are being covered. Like for example, in this case, I'll just go through very quickly. Loss of income. Okay, what is the measures I would have reserved to help to fight against it? I have insurance for illness, then of course have alternative income to fight things like retrenchment, so on and so forth. Okay, so reduction income, same thing, the reserve and the alternative income. So lots of savings. Okay, right. So I basically hide cash in investment, a lesser chance of being scammed. Of course, it's not foolproof. Lesser chance of being scammed. Then I do things like diversification. Okay, diversification. So again, that one will prevent loss of savings. And plan large expenses. So like for example, I have my reserve. Again, same thing for insurance and alternative income. So this is what we call the full risk management mindset. That means think in terms of risk. Okay, really list out the risk. What are the risk mitigating measures? And eventually does the measure go and cover all your risks or not? So that is the key point that I want to put across here for risk.